Good afternoon. Happy Friday. Mark Milam here, April 28th. Let's get right to it. A bit of a mixed bag this week for mortgage interest rates. Some of the good news coming from the fact that we really didn't hear a whole lot from our Federal Reserve members. Some of the bad news coming from some inflation data, jobless claims. As we all know, the Fed wants to drive up joblessness in the United States. They view increases to unemployment as a way to put inflation back in the bottle. Did not get good news on that front this week. As a matter of fact, let's flip the screen around here and scroll down. We can see initial weekly jobless claims coming in at 230,000 against a consensus estimate of 248. That's the wrong direction. It sounds weird to say that we want joblessness to go up, but candidly, it's just going to have to get over 300,000 on a 4-week moving average before we're going to see the Fed take their foot off the gas. They're operating off of an old playbook from the 1980s that says if unemployment is high, inflation will go down, and that's what they've got their sights set on. Until we see joblessness go up or increase, odds are we're going to have a very active, hawkish Federal Reserve. What else happened this week? Well, let's take a look at the PCE number. This is the personal consumption expenditure. The month-over-month number coming in kind of low, actually, 0.1%. That's the lowest level since July of last year in terms of month-over-month PCE. That was against an estimate of 0.3, but the overall number, the annual number, came in a little hotter than expectation. Again, kind of a mixed bag here of information. So why did we see the market tend to do relatively well this week? Well, I have a theory, and here it is. So the Fed goes into a blackout period prior to any Federal Open Market Committee meeting where they're announcing changes to the Fed funds rate. This is blackout period means they don't talk to the press, they don't hold press conferences, they don't go on late night talk shows. There's no activity from the Fed, and several members of our Fed are very vocal about their intent to continue hiking interest rates until inflation comes down. That is not good for our markets to have that kind of activity, that kind of vocalization from multiple Fed members across the span of 5 business days. So ultimately, when the Fed goes into a blackout period, if you take a look, mortgage-backed securities tend to do better during the blackout period than when the Fed is talking to the press. Now, obviously that's just one data point, but there's enough of a trend here to make an argument that the markets appreciate the respite of no Fed activity, no Fed communication during the blackout periods, and you can achieve better interest rates during those blackout periods than you might otherwise achieve with the same set of factors. So just an interesting data point. Let's move away from talking about the Fed. We all know what they're going to do. May the 3rd, next Wednesday, 2 p.m. Eastern Time. Bank on it. The Fed is going to hike the Fed funds rate by 0.25%. Prime rate goes up accordingly. We'll be at 8.25 with prime rate by the time 2:30 hits on Wednesday of next week, May the 3rd. Moving on to loan level price adjustments. If you've been reading the news, I'm sure you've seen headlines like this: why having good credit could cost you more on a home mortgage, how the U.S. is subsidizing high-risk home buyers at the cost of those with good credit. You could see planned unprecedented changes to mortgage fees already impacting borrowers. And then hear from Yahoo Finance, mortgages for home buyers with good credit to cost more starting May 1. High-risk borrowers will pay less. So let's get right to the information, because there's some misinformation out there. Are you going to get a better interest rate on a mortgage if you have bad credit versus someone with good credit? Absolutely not. Good credit borrowers will still have a far better interest rate than borrowers with poor credit. What is changing is the difference between those two candidates, the difference between those two clients. Good credit clients will now not get quite as good of an interest rate, and bad credit clients will now get a little better interest rate. And the problem here is where a lot of people have some heartburn, including me. The problem is the improvements to pricing from Fannie Mae and Freddie Mac for poor credit borrowers are being done on the backs of those with good credit. So your good credit clients are going to see their pricing worsen. Borrowers with bad credit are going to get improvements to pricing. And that's the problem we have right now in the United States. You hate to drag politics into home buying, but that's exactly what has happened. It happened with the prior administration, with Trump and Calabria. It's happening with this administration, with Joe Biden and Sandra Thompson. We are leveraging the Federal Housing Finance Agency to achieve political ends. Because the head of the Federal Housing Finance Agency is an appointee of the president, We could see this every 4 years, conceivably. Let's say that Biden loses the next election and we have a Republican president. We could see a complete changeover, a complete change in philosophy, updates to the loan level pricing adjustment, updates to product guidelines. You could see now that how the Federal Housing Finance Agency is leveraging Fannie Mae and Freddie Mac, technically private enterprises under the conservatorship of the government, to achieve political ends. And that's a problem, because loan level price adjustments are supposed to indicate risk-based pricing by the credentials of the person qualifying for the loan. If you have good credit, that's a low-risk loan. They haven't presented any kind of data, any kind of actuarial table, any kind of anything to state that the loan level pricing that we had before was failing, that the decades or more of loan level pricing adjustments that we've been relying on in our industry for quite some time have some kind of inherent or fundamental flaw. That is not the case. They've simply tinkered with the loan level pricing adjustments to achieve a political end, and that is a problem, not necessarily because of what they're trying to achieve, but it's a problem because now we've opened up Pandora's box to politicizing Fannie Mae and Freddie Mac to achieve a certain party's goal. That's a significant issue, and that's why you're seeing such strong feedback. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com.